Hi, welcome back. If you have been watching silver over the past few weeks, you have probably noticed something a little strange. Physical demand is strong, mints are struggling to keep up with coin and bar orders, industrial buyers are locking in supply, and yet the price keeps running into the same wall. It gets close to $60, investors get excited, headlines start talking about a breakout, and then it stalls and pulls back. If you have felt confused by that pattern, you are not alone. And today, we are going to walk through exactly why this is happening. Here is what this means for anyone paying attention to their savings or their portfolio right now. Silver is not behaving like a market with no demand. It is behaving like a market where demand is real, but something else is holding the lid on. Understanding that difference matters, because it changes how you interpret every price move you see going forward. So let's break this down piece by piece, starting with the first force at play, which is the relationship between paper markets and physical markets. Most people assume the silver price you see quoted on your phone or your brokerage app is set purely by people buying and selling actual metal. In reality, the price is set mostly in futures markets, where contracts representing silver change hands in enormous volume every single day, often far exceeding the amount of physical silver that actually exists in vaults. Think about it this way. Imagine a small town with only a few hundred houses, but thousands of people trading paper certificates that represent ownership of those houses. The certificate price can move up and down based on trading activity, sentiment, and leverage, even if the actual houses themselves are not changing hands very often. That is roughly how the silver futures market interacts with the physical bullion market. When large trading positions get unwound, when funds rebalance, or when technical selling triggers stop losses, the price can drop or stall even while somebody somewhere is lining up outside a coin shop waiting to buy real bars. Now, this is important because it explains why you can read a headline about record demand for silver coins and still watch the price sit flat the same week. The paper market and the physical market are connected, but they do not always move in perfect sync, especially in the short term. Over time, physical scarcity tends to pull the price toward it, but that process can take much longer than people expect, and during that lag, prices can feel trapped. The second force holding silver back is the strength of the U.S. dollar and the direction of interest rates. Silver, like gold, is priced in dollars around the world, which means its price is sensitive to how strong or weak the dollar is at any given moment. When the dollar strengthens, silver becomes more expensive for buyers using other currencies, which can cool demand from major importing countries. At the same time, interest rate expectations play a huge role. Silver does not pay any interest or dividend, so when interest rates are high or expected to stay high, investors have an incentive to hold cash or bonds instead of metal, because those options actually generate a return while they wait. Silver just sits there. Here's what this means practically. Every time the Federal Reserve signals that rates might stay higher for longer or that inflation concerns are not fully resolved, some investors shift money away from precious metals and back into interest-bearing assets. That shift adds selling pressure, or at least removes buying pressure on silver, even if nothing has changed in the physical supply and demand picture. This is one of the main reasons silver can look strong on the ground, with real people buying real ounces, while the price on screen struggles to break through resistance. The third force is a bit more technical, but it is just as important, and it has to do with how large institutional traders and algorithmic systems respond to key price levels. $60 is not just a random number. It represents a psychological and technical ceiling that traders have been watching for a long time. When a price approaches a level like that, especially one connected to previous historical highs, a predictable pattern tends to unfold. Some traders take profits, assuming the level will hold as resistance again. Others place sell orders just below that level, anticipating a rejection. Automated trading systems, which react to price patterns rather than emotions, often pile on in the same direction once the pattern begins, which can accelerate a pullback. This creates a kind of self-reinforcing ceiling where the very belief that $60 is difficult to break becomes part of the reason it stays difficult to break, at least for now. Let's put these three forces together, because individually they might seem small, but combined they explain a lot. You have a paper market that can move independently of physical scarcity in the short run. You have a currency and interest rate environment that adds pressure against holding non-yielding assets. And you have a technical ceiling that attracts profit-taking and automated selling every time price gets close to it. None of these forces are secret or hidden. They are simply structural parts of how modern commodity markets function, and understanding them helps you make sense of price action instead of feeling confused by it. If this kind of breakdown is helpful, consider subscribing so you don't miss future videos where we walk through what's actually moving metals markets without hype and without guesswork. Now let's get back into it, because there is more to this story, particularly around why physical demand keeps climbing even while the price stays capped. Industrial use of silver has been quietly growing for years, driven by solar panel manufacturing, electric vehicle production, and electronics that require silver's unique conductivity. At the same time, investment demand for coins and bars has remained elevated, partly due to ongoing economic uncertainty and partly due to renewed interest in tangible assets. When you add industrial demand and investment demand together, you get a market where more silver is being used and bought than is being newly mined each year. That gap has to be filled somehow, usually through above-ground inventories, which slowly get drawn down over time. Here is where it gets interesting. A shrinking inventory does not automatically cause an immediate price explosion. Markets can run on tightening supply for a long time before that tightness actually forces a price adjustment, especially when the price is primarily being set by financial trading activity rather than physical scarcity alone. Think about it like a bathtub slowly draining while the faucet is barely dripping. The water level drops gradually, and for a while, nothing dramatic seems to happen, until the level gets low enough that a real problem becomes impossible to ignore. Many analysts believe silver is somewhere in that gradual draining phase right now, which is part of why physical premiums, meaning the extra cost buyers pay above the spot price for actual coins and bars, have stayed elevated even while the headline price is capped. It is worth acknowledging that not everyone agrees on how this plays out, and that is a healthy thing to keep in mind. Some analysts believe the current setup is building pressure toward a significant breakout once the technical ceiling finally gives way, especially if inventories continue to tighten and interest rate policy eventually shifts. Others are more cautious, pointing out that markets can remain capped for years, that new supply can come online from recycling and mining expansion, and that demand patterns can shift if economic conditions change. Both perspectives have valid points, and neither should be treated as guaranteed. This is not a situation with a certain outcome, and anyone claiming to know exactly what happens next is overstating their confidence. A useful mental framework here is to think of silver's price as sitting inside a kind of pressure chamber. Physical demand and shrinking supply are building pressure from the inside. The dollar, interest rates, and technical resistance are acting like a lid, holding that pressure in. Pressure chambers do not release gradually most of the time. They tend to hold steady for a while and then release relatively quickly once the lid can no longer contain what's building underneath. Whether that release happens because interest rates fall, because the dollar weakens, because inventories hit a critical low point, or because a combination of all three lines up at once, nobody can say with certainty. But understanding the chamber itself, rather than trying to predict the exact moment of release, gives you a much clearer way to follow this market without getting caught up in short-term noise. So what should you actually be watching if you want to track this situation going forward without treating any of it as a prediction or a recommendation. Keep an eye on how silver behaves specifically around the $60 level. Repeated attempts, followed by rejection, tell you the ceiling is still intact. A close above that level, especially on strong trading volume, would be a meaningful technical signal worth paying attention to. Also, watch the relationship between physical premiums and the spot price. When premiums stay high or keep climbing, even as the spot price is flat, that is a sign the physical market is tighter than the paper price is currently reflecting. Finally, pay attention to Federal Reserve commentary around interest rates. Any meaningful shift toward rate cuts tends to reduce the opportunity cost of holding non-yielding assets like silver, which historically has supported higher prices across the metals complex. Now let's talk about why any of this actually matters for your day-to-day financial life beyond just watching numbers move on a screen. For people who hold silver as part of a diversified savings strategy, understanding these forces helps you avoid emotional decisions. It is easy to get discouraged when price stalls despite good underlying fundamentals, and it is equally easy to get overly excited during a short-term spike. Having a clearer picture of what is actually driving the price rather than reacting purely to headlines gives you a steadier, more informed perspective. This applies whether you are someone who has held physical silver for years, someone considering it for the first time, or simply someone who wants to understand how commodity markets function as part of the broader economy. It's also worth remembering that markets like this rarely move in a straight line. There will likely be periods of frustrating consolidation, sudden sharp moves in either direction, and plenty of noise from short-term traders that has little to do with the long-term supply and demand picture. Zooming out and focusing on the structural forces, the paper versus physical dynamic, the interest rate and dollar relationship, and the technical resistance around key levels gives you a framework that stays useful no matter which direction the next big move ends up going. To bring this all together, silver is currently caught between two very different realities. On one side, you have genuine, measurable demand from industrial users and everyday investors, combined with supply that is not keeping pace. On the other side, you have a financial market structure, currency dynamics, and technical trading patterns that are actively working to keep the price contained below a key psychological level. Neither side is fake, and neither side is guaranteed to win quickly. What we do know is that pressure like this does not simply disappear. It tends to resolve eventually, one way or another, and paying attention to the signals we just walked through, the $60 level, physical premiums, and interest rate policy, will help you understand that resolution when it starts to unfold, rather than being surprised by it. That's the picture for today. Silver trapped below $60 is not a mystery once you understand the forces involved, and it is not a reason for panic or excitement in either direction. It is simply a market working through a very normal, very human tug-of-war between short-term trading dynamics and long-term physical reality. Keep watching those key levels, stay informed rather than reactive, and you will be in a much better position to understand whatever comes next. Thanks for spending this time with me. If you found this useful, subscribe for more breakdowns like this one, and I will see you in the next video.